Hi guys, so let's now take a look at monopolies. Right, so when it comes to a monopoly, really you're dealing with a pure monopoly when we refer to this term in economics. And a pure monopoly represents one dominant firm in the market. So theoretically they should have 100% control of that market, 100% market share. They are the market. Okay, so that's the crucial factor here. In practice, I like to refer to local examples of monopolies. So for instance, if you consider a local football team, they may have a monopoly position when it comes to actually being able to set the prices for their football shirts and the season tickets and so on. Because they have such a loyal following, demand for the product is considered highly inelastic because of its unique features. So I like to refer to local monopolies, but it's also really useful to think about drug companies when it comes to monopolies. And drug companies will be granted patents which can last up to 25 years, patents or patents. Now, those patents will then enable the firm to actually sell that drug at a high price at a low output level for the next sort of 25-year period or so. So that can be really, really significant in terms of generating monopoly power. Okay, so let's have a look at some of the assumptions that we've got here. First up, there's one single supplier, there's unique products. And this means, in contrast to what we saw with a perfectly competitive firm, we have a price maker, not a price taker, a price maker. So they make the price in the marketplace. Number three, high entry and exit barriers here. Okay, so there's high barriers to entry and exit. They may be about generating significant economies of scale to be able to compete with a monopoly, or it might be about marketing barriers to entry and exit. Marketing barriers to entry to actually gain enough presence within a marketplace. So for instance, how would you go about competing with a supermarket? You'd find it very, very difficult due to the significant cost advantages they will have against you as a business. In addition to this, there's imperfect information, and this really means that the monopoly knows more about what is taking place within the market than everyone else does. So that's significant. And then number five, firms are profit maximizers. So they will attempt to profit maximize. Now, neoclassical school of economics really focuses on profit maximization in the short run. Now, this is a really interesting point. Do they focus on the short run, or are they more longer term focused? Well, it very much depends. Anyway, let's have a look at the diagrammatics then for a monopoly. As we said, we're dealing with a highly inelastic demand curve, and we can see that there. D equals AR. Demand equals the average revenue. So this is highly inelastic due to the unique characteristics of the product and the fact that the firm is a price maker. In addition, we see our marginal revenue curve like so. We see where marginal revenue equals 0. Now, we also see our marginal cost curve here. Now, our marginal cost curve, of course, intersects our marginal revenue points to tell us where that profit maximization level of output is. Because as soon as we go beyond that point, of course, marginal cost, the cost of providing that next additional unit of output, exceeds the marginal revenue, the revenue gained from selling that next additional unit of output. So you want this marginal revenue curve to be greater than the marginal cost, in essence, if you want to be a profit maximizer. In turn, that will ensure that the distance between total revenue and total cost is at its greatest at this point. Okay, so look at this. Ouch, look at this price. Here we go. Right up there. So there we go. Let's just put down PM for the price in monopoly and QM for the quantity level within a monopoly. Okay, nice. So this is looking good. The next thing we need to factor into this, of course, is the actual average cost curve. So the average cost curve, of course, has got to intersect At the bottom, it's got to intersect or have the marginal cost intersecting at the lowest point of the average cost curve. That's really important, and we can see that there. Then we can highlight the area of supernormal profits that is being made. So there it is. Okay, and let's just put down PP, because then we'd be able to say, right, okay, so point A and then point B, and you can then say, right, so the area of profits equals PM, A, B, PP. Nice. Okay, this is looking good. So this is all profit. That is really significant for the monopoly. The question is really, how are they going to use this profit? Are they going to use it to improve the quality of services in the future and help to reduce prices in the future? Or are they actually going to use this to help build up further barriers to entry, to make it harder for other firms to enter the marketplace? And this is a really important question. Right, so let's look at these advantages. Firstly, there's the potential. Notice I've underlined that. It's worth underlining twice. Now, a good student, like a B grade student, they'll say, look, they're making supernormal profits, highlighted by this red shaded area. Great, this means they can be dynamically efficient. But will they? There's the potential that they could be, but will they? That is likely to depend upon the firm's objectives. Okay, perhaps a good example of this is when it comes to Apple and Google and Android's device integration system that they have. So for instance, your iTunes will be available on all of your Apple platforms that you actually own, whether it's an iPad, iPhone, iMac and so on. Now that's great, it's convenient, but there's a big upside there as well for Apple and Android in the way that their systems integrate. That effectively reduces the switching power of consumers and the ability of consumers to actually then switch to other products. So it means you're almost tied into buying into monopoly products, okay? And this demand curve would become even steeper. So what are they using this supernormal profits for? Are they really improving the product base of future products that are going to be available, or are they simply building barriers to entry or exit for the consumer? Okay, number two. There's the potential for economies of scale, because remember, the monopoly is the industry. This marginal cost curve is effectively the industry supply curve here. So as such, it means that theoretically a monopoly can generate huge economies of scale. Now, within a local monopoly, say a football club, obviously those economies of scale won't be fully realised, and we don't know whether all monopolies will truly realise their available economies of scale. But there is a potential argument here that could say, well, if they are really dynamically efficient and they invest in their own processes and in their own operations, then they might be able to generate a lower average cost level than perhaps a perfectly competitive firm. Because perhaps a perfectly competitive firm's average cost could be up here. So therefore you could perhaps argue that there's a lower price under a monopoly. Number three, granting monopolies may be the least bad option. This is really about the theory of the second best. So if you think about those patents or patents, when it comes to granting those for drugs to treat life-threatening diseases and conditions, of course you're granting monopoly power. As you grant that monopoly power, it means that they can exploit the market, they can restrict the available supply and charge a high price. Okay, now that is good news for them, but of course there is this area of deadweight economic loss. And this area of deadweight economic loss, well, this represents two things. It represents consumers who otherwise would have loved to have actually bought that drug and consumed that product, but in addition to that, it represents other producers that would have been able to actually copy that product and produce more of it. So, you know, is monopoly a good thing in that circumstance? Because without that incentive to become a monopoly and be granted that patent or patent, then why would they bother doing it? Why would they bother investing in the future? So is it the least bad option? What a wonderful question to pose. Big marks there. Okay, right, disadvantages. Number one, high price, low output. Well, we see that nice and obvious, isn't it? Okay. Number two, well, what we see here is that firstly, price does not equal marginal cost. So price does not equal marginal cost, so it's not allocatively efficient. We're not at this lowest point of the average cost curve, so they're not productively efficient either. So that again is significant. Okay, it means that the actual price level, of course, will be higher. And when it comes to the allocative efficiency, not all consumers are able to buy this product, and there is an area of producer surplus, and that's lost jobs from producers that otherwise could have made this product. Okay, so number three, yeah, we see that deadweight economic loss, and we've been talking about what that can represent. And if you actually show that you understand exactly what this triangle means, you'll be setting yourself apart from all of the other students who just say, oh, there's a deadweight loss, but don't know what it means. So really focus on that detail in your analysis there. Number four, what about the objectives of the firm? So again, this is such a lovely point. We mentioned that in relation to this dynamic efficiency, and that's where you'd be able to actually compare and contrast these points. How are they going to use these supernormal profits? Are they going to focus on long-run profit maximisation? Firms that are really famed for doing so include Amazon and Netflix. Great examples of firms that really invest in the future and offer a much lower price than would normally be suggested under monopoly conditions. Great stuff, guys. I can see you're going to do well on this. Right, see you next time.